What is up, guys? Welcome to another Market Radar podcast. Let's take a look at what the NASDAQ did this week. We did see a pullback, finally. It's about time. But it's just price action, not really much of a reason behind it other than price action. Obviously, with the massive run-up we've had over the past couple of weeks, it's to be expected. It is still holding above mid-vamp though, so we do have forward upward momentum, and we'll have to see if we're able to break below lower vamp, mid-vamp, and then we'll see if we can get to lower vamp. But at the moment, we're still above mid-vamp, so we have the upward momentum. We do have a pretty big week next week. We'll talk about that later, but that is definitely something that could bring the NASDAQ lower, depending on how next week goes. But let's take a look at bonds. So bonds as well, holding above mid-vamp, which is a good sign if you're looking for that deflationary trade, which we are. We're looking for it. Obviously, we're not in the deflationary trade yet. We are waiting to get above Momo and waiting for the system to align for us to have that confirmation for our trade, because we do use triple leverage. So having proper timing is crucial. And so bonds are holding. We're looking at ZB here, holding above mid-vamp. Did fail to break below it on Thursday. We broke below it throughout the day, but it was able to close above mid-vamp. So we still have that strength in bonds, and we might see Momo in the next few weeks. Who knows? We do have GDP coming out and FOMC next week, so that can definitely move bonds up to Momo pretty quickly. So let's take a look at the calendar for next week. We have PMI on Monday, consumer confidence on Tuesday. We've got FOMC on Wednesday. That's going to be a big one. New home sales as well on Wednesday. Thursday, we've got GDP, jobless claims. So it's a big week next week. So be prepared. Friday, we have personal income and outlays as well. So what we want to talk about this podcast, it's something that I think is on a lot of people's minds, and we haven't really talked about it because, quite frankly, we're not experts, and we want to talk about real estate. So we're not experts in real estate. That's why we don't really talk about it. We deal with stocks and bonds and, the good stuff. But I think it's important to talk about real estate since, everyone buys property at some point in their lives, and people are wondering what's going on now, and is it a good time to buy right now? Are houses going to crash 60% like in 2008? So I think we should talk about that. So to start it off, Gamma, what do you think is going to happen to housing if interest rates stay at these levels for the next year or two, like the Fed has been saying?
So I think that the way housing is structured is very unique, and it comes down to the circumstances that create these housing drawdowns that we see, or these, call them dead periods, right, in the market, where housing doesn't really progress, doesn't really fall. A good example would be like this area right here. Housing grinds up slowly, but it doesn't really move higher. After 2008, we had this lull period, and even here in the 90s, housing pretty much flatlined, right? And a lot of people. So I'm going to answer your question in a second, where I think where housing's going to go based on the duration of rates. But a lot of like the stock market, there are housing pessimists, like they're stock pessimists, right? You can you'll find a perma bear, and no matter where the stock market is, if ES is at 4,500, 4,800, 6,000, or 10,000, they'll tell you the market's overvalued. There's always a metric that you can find that will overvalue or undervalue something. You can always fit the data to your narrative. This is possible, and this is why there is such a wide variety of opinions in the stock market and in real estate, right? Because you can look at price to rent, price to income for housing, and be like, wow, it's very expensive. Or you can look at something like the cost to service such mortgage against real disposable income, and it's not so severe. So you can look at these data sets, or basically analyze a lot of data sets and come to multiple conclusions that don't really align with each other. So like I said, it's a wide ranging topic, right? So I think house prices aren't as doomed as a lot of people say they are, and there's two main factors. Number one, let's just take recessions, right? We've experienced four columns, clearly defined recessions since the early 90s. And all out of those four recessions, only one of them really was um, very detrimental to housing prices, and that was 2008. Now, if you if you know, 2008 was housing related, right? I mean, the whole bubble was basically um, a fundamental issue around bad mortgages, or I should say, mismanaged mortgages and and incorrectly qualified debt, right?
Yeah. So
That
like
was
there was
2008
essentially fraud involved, and that's what caused
to a
that.
degree,
Yeah.
right? There was basically rules, or I should the rules maybe weren't as solidified or as structural as they are today, and they were being loops were being put in place. People were getting pushed around the borders trying to get mortgages, 3, 4, 5 homes, things like that of that nature that are really just highly speculative. What happened in that time period was housing prices basically turned into what the meme stocks were a year or two ago. Everyone was getting one, right? And that pretty much ended with the bust. Now, granted, that was a housing crisis that stemmed onto these banks, right? These banks had mortgages that they thought were secure because they were basically diversified dog shit, right? They were just poor bonds grouped together with the idea that the law of large numbers would yield diversification across basic bankruptcies. And unfortunately, the complete opposite happened. Big banks were left with huge holes, and some never made it, and some got bailed out, and some did actually make it just fine. I think we're in a different situation today where the banks aren't so much the issue. Now, you're probably listening, or some people are probably listening and going, what about commercial real estate? And we'll talk about that in a little bit as we go through this. But where I want to go back to is this is not a housing related crisis. We're not in a housing related crisis right now, because the odds are that not as you can see, every recession is not a housing recession, right? Um, Now, while recessions do affect the ability to purchase an individual or family's ability to purchase a home, they're not outright housing recessions. So you have to have a very unique circumstance. Now, obviously, let's just say a Great Depression were to occur. That would most likely encompass housing depression, right? That would be everything. A Great Depression and everything depression is going to be a housing depression. But if it's just your normal run recession, well, or even mediocre recession, well, odds are, as you can see, housing shouldn't really be that affected. Now, a lot of people are probably saying, well, I want to make a note that the Case Shiller went from 220 to 301, right? Big move, big surprise, obviously up a lot since 2020. Price has to revert, right? Prices must come down. The answer to that, unfortunately, is not always. And the reasoning behind that is home prices, obviously, we only have so much land in a country, right? There's only so much buildable land or developed land that could be developed. Um, while there are new houses being added to the market over time, there's this general idea that when you own a piece of real estate, you own something that is finite. Even though they are building more homes, in terms, you own something that is finite. There's only so many houses in reality, right? That exist, which is why they are very expensive, because we have a lot of people that are looking for houses, and therefore houses deserve a premium, right? Because there's only so much land, which is pretty much declining, right, in terms of use as the population grows. So real estate holds an intrinsic value.
Right.
Now,
And that also makes it highly correlated with inflation as well. All
exactly.
finite resources. That's why
Yep.
you see commodities are highly correlated with inflation, because those are also finite resources.
Right. And as you see this move here in 2020, this was not only housing demand, rate demand, but inflation. This was corrected for inflation, right? You had we printed in 1 year we did like 20% plus of money supply, increasing the money supply, right? We've increased the money supply and over, I think it's close to 40% since COVID. Something ridiculous, right?
Right. So having house prices rise 40% is in line with the rise in the money supply.
Right, to a degree. Now, you have to also understand that the economic cycle is going to play a role in the continuation of this price incline, right? So let's just say we have money, we have M2 right now. It's pretty much the deepest levels ever recorded. We have one of the deepest contractions in M2 money supply. Now, what that means is technically there's this vacuum of money in the market that's being sucked out. And that's primarily due to the higher cost to borrow, right? To get access to money now compared to COVID, it's a lot different. Like I'm talking COVID era where rates were 1 to 2%. You couldn't get access. You were able to access funds a lot easier than you are right now. If the mortgage rate's 3%, and the way that this plays out, it comes back to so the reason why the home price or money was so easy to access during that time period, right, is not so much the interest rate. And the reason home prices went up in conjunction with this was it all comes down to the way everyone looks at real estate, right? Nobody really cares about the sticker price on real estate. Just because home prices are up, nobody really cares. Because at the end of the day, pretty much almost all real estate in America for the average person is financed, right? So everyone doesn't look at call it the notional value of real estate. They look at the finance value of what it's going to cost them every month, which in America, most of the time it's a fixed mortgage. Most mortgages are fixed. Now most could assume that ARMs are going to take a bigger market share due to the fact that everyone expects rates to fall. So everyone's going to take out an ARM, or more people are going to move to the ARM side of things because they get to capture the depreciation in rates when they do go down. But long story short, most mortgages are fixed, and we all know that, right? So everyone is basically fixing their monthly payment, and when rates are really low, everyone gets to fix a nice low monthly payment, and it doesn't really matter what the home price is as long as the monthly payment's low. It doesn't really matter, right? At the end of the day, you own the house in the end, low interest, you win. You can afford the monthly payment. What's going on now is the reason why homes are the home market slowing down is because people in a general view are approaching the housing market and they're wondering, well, that same house, that same price, just over the last 2 years has gotten significantly more expensive because rates went from 2 to 3 to 4 all the way up to like 7 or 8 depending on your credit. And that's very detrimental towards the person, number one, who's buying the home, because that monthly payment has now skyrocketed, and the cost to own that home. Again, most people don't really care about this, but that has gone up significantly as well. Like, something like you can do like a ballpark $300,000 home, 8% rate. It will end up costing like $700,000 or something. The numbers work out something like that, $700,000 over the next 30 years. Think about that. You're to break even on that home at 8%, your house needs to be pretty much over doubled in value.
Yeah.
Which is crazy.
Well, so from the point of view of a person that's looking to buy a property right now, and they're waiting for interest rates to fall, taking it back to our whole theory of the soft landing turning into the hard landing and everything, the hard landing is only going to come once unemployment rises. Unemployment rising, you would assume, is bad for real estate because people won't be able to pay their mortgages if they're getting laid off. But then the other side of the coin, once that hits, the Fed's going to be cutting rates, which boosts the housing market. So how does that really work? How is that going to play out for house prices? You kind of have like this tug of war with unemployment pulling prices down, but then rates being cut, pushing prices upwards. So what's going to really happen once that hard landing does hit?
I think it matters again on the context of that hard landing, right? Like is it a shallow recession? Is it a deep recession? Is unemployment only going up to 5%, 6%, or is it going all the way up to 8, 9%, right? Um, that comes down to the situation as it unfolds. But an interesting take on the unemployment rate, if we look at the home price index, and you know what, let me see if I can do a home price index year over year, because I know, you know what, let's not even worry about it. Let's do it like this. Let's go 1 month and let's go this here. So we can see home prices year over year. And the reason I'm going to display this is because I want to show what happens here with unemployment and home prices. And this is something we can just pull up, which we did pull up here real quick. Disable it. So here's the unemployment rate, and here's home prices, right? So, and these are the last 4 recessions, of which the only one that saw a dramatic slowdown in home prices was 2008. The 2001 recession, home prices pretty much were chugged higher. Didn't even really slow down. They slowed down on a rate of change basis, but they were still growing. The home price was still appreciating.
Right. So 2008 and a little bit in the 90s was the
Yeah.
only time you really saw housing drop.
Right. And now, like, let's play the role. Let's play this role, right? House prices have come down like what, 2%, right? In the national average. I mean, I'm sure in some places it's different, depending obviously on how much you've overpaid at the time you purchased the house. Long story short, it's down 2% over year. When you purchase a house, you have to weigh out. Obviously, no one wants to refi a home that they're basically underwater in, right? Um, no one. I mean, theoretically, you can't, but whatever. Long story short, rates going down should have a contrary effect on home prices, right? So you have this situation going on right now where home prices are or some would consider very elevated, but on a year over year basis, they're pretty much flat, right? Which is to be expected. And if rates fall from here due to that recession, maybe unemployment ticks up. Let's go back to what I spoke about earlier being that monthly payment. That monthly payment starts dropping for the home prices need to go down. You essentially cutting rates will open up more demand for housing, theoretically.
Right.
As long as it's not right, you get what I mean, right? As long as it's not a housing related crisis.
Yeah.
So
or a very severe depression where even cutting rates to zero doesn't outweigh the unemployment.
Right. And it makes such a unique situation, right? Because like right now, if we look here, I have two lines plotted here. I have the month supply of new homes and month supply of existing homes, meaning if no new homes came to the market, only the supply on the market was available at this point in time, it would take about 6.7 months to sell all the newly constructed homes, and it would take about 3 months to sell all the existing homes that are on the market. In 2008, in most of these recessions, we see this actually spike, most of them, right? Reason being is no one's able to purchase these homes, home prices go up. I mean, supply goes up, right? We're not seeing the supply go up right now. We're actually seeing the supply come down. The market remains tight. And the reason for this is we can look here is the active listings are down 16% year over year in 2023. Now, why is that? Why is the supply going down? And the answer is very simple. It's the rates. Rates are up. Now, everyone is under this impression that, okay, so I want to go back to what you said at the beginning quickly. We're not real estate experts. I've never worked in real estate, but like every market that requires a buyer and a seller, there's the mid component of psychology that has to play a big role in the execution of that transaction, right? So with rates going up the way that they have, we did see one of the fastest rate rises in history, right? Or in modern times, right? Going from literally the Fed holding rates at zero on a rate of change basis, it was extreme, from 0 to 500 basis points in like a little over a year. And mortgage rates from 2, 3 all the way up to 7, 8. Now, it's in such a short amount of time that typically as mortgage rates get higher and the cost or the burden of a mortgage increases, you're going to have less and less buyers at certain prices. They have to come down in price. But what's happened is you have all these new home buyers within 24 months 24 months prior that have locked in super low mortgages, that even if they wanted to make a lateral move, they just wanted to move from one neighborhood to another for the same home price, they're going to incur substantially higher monthly bills. For what reason? They look at it. It makes very little sense to make any lateral moves. If anything, to keep your mortgage payment in that same ballpark, you have to downgrade, which typically typically the way this works is when someone buys a home, they start and end up in starter homes. They're as stupid as that sounds, right? They start in a starter home, they build up equity, they roll it into bigger and bigger homes, and then as they get older, they downsize back to that starter home level, right? Like that's like call it like a bell curve, right? So no one wants to buy a starter home and then buy a lesser value starter home, or upgrade once and then go back to a starter home. Nobody wants to do that. Everyone wants to make vertical, incremental upgrades. No one wants to make these horizontal to lower downgrades, right? So that's the issue that's basically happening here is everyone's stuck in a mortgage. You're seeing the supply basically dwindle, right? Because who's going to want to sell unless they are no longer in the deceased? Who's going to want to sell and buy something else unless it's all cash? We know most people operate in mortgages. Why pay cash for something you can refi out? Well, right now, it makes sense to pay cash at 6-7%. Your hurdle rate is so high, right? If you have the cash, you want to spend cash right now because, let's just say the average return in the S&P 500 is anywhere from depending on your period of measurements, from 7 to 11%. Mortgage rate at 7%. It's not like, I'm better off getting a 2% mortgage, investing the rest in the market and waiting. That's what some people, you can make that argument, but at 7%, you're now looking at the, market and you're like, well, if the average returns, it doesn't make sense. It makes sense to pay the mortgage off as fast as possible. And I think the higher rates will likely affect housing, or will have a more minimal effect to housing than most people think, right? So back to housing, let's look at that quickly here. For housing to really, I'm talking, everyone, Wall Street has, and the participants and FinTwit have a very short memory. They think housing crash, they just think about 2008. That's all they know. And I think to see 2008's now at this point in time, I don't think that's realistic. Maybe we get a little bit more of a negative slide like in the 90s, possible, right? And if that happens, I think housing is the last thing to get hit because housing is one of those like sticky things that like, you don't just buy and sell houses like you do stocks in your brokerage account. You have to move, especially primary residences. It's a hassle. You're not buying a new house every other month and selling and buying, because automatically most people incur these realtor fees, right? So you're getting anywhere from 4 to 8%, 6% haircuts, and it's just it's problematic, right? So it's a money losing game to be moving rapidly like that without allowing for appreciation in the home to outprice or basically negate these fees incurred with moving and closing costs and all these things.
Yeah. So bottom line, we don't really think housing is going to crash. It's probably going to slow down. I mean, it's already slowed down. It's likely going to stay slow, but definitely shouldn't be expecting a 50% haircut in real estate. At least that's the way I see it. Like I agree. We're nowhere near a 2008 situation. A lot of this house price increase has been driven by inflation, not due to speculation like we had in 2008. So it's really, if you are in a position right now where you're looking to buy a place, but you're waiting for rates to cut or whatever, waiting for house prices to drop, it's probably not going to happen. I mean, definitely not to the extent of 2008. That's just the way I see it. But then again, I'm not a real estate professional or anything. We know stocks, we know bonds. It's kind of similar, but real estate is a different beast, and it's actually a whole lot harder to predict, specifically because of the reasons we mentioned, with rate cuts helping it. So you're looking for a recession to drop prices, but then you got rate cuts that will drive the prices higher. You have the strong correlation with inflation as well. You've got people actually living in the homes as primary residents. There's reasons why people won't sell. It's not like a stock where you can just, oh, I'm going to lock in profits. It's a house that you're living in. So there's a lot more nuances to real estate, and
Yeah, I got a good question
it
about
makes it
that.
hard.
How do you lock in gains on a house that you live in?
Well, you can refinance.
That's
So
that's your only way, right?
that's that's the only way I know of. At least I'm sure there's some other
But you're still
advanced
holding the
things.
bag with the debt, though, right? Theoretically, when you refi, you're still
Yeah,
holding the bag with the debt. Where, like, think about it. If you need to get your, let's just say you're up 200K in the house and you want to get that 200K out, and you want to actually lock those gains in. The only way to do that is to sell the house, right?
yeah,
But then where do you move?
yeah. So yeah, like people are landlocked right now, pretty much
Right.
with these interest rates, and that's why we're seeing such a slowdown in real estate. So yeah, it's hard, but take what we say for what it's worth. This is our take on real estate. I think it's kind of been a long time coming since we talked about it. It's a lot of people are wondering what's going to go on with real estate, and that's what we think is going to happen. We don't think we're going to get a crazy correction or anything. Most likely, it's just going to be a slowdown with house prices slowly chugging along as demand starts to pick back up, as people start realizing, okay, you know what, like people need to buy a place. People can't just be not buying a place for the next 5 years. So eventually demand is going to come back in, and the very minimal supply that's out there is going to be bought up, and house prices will slowly chug back higher. That's the way I see it happening. And you've got inflation pressures still pushing it as well. So we're still in an elevated CPI environment. So that's a constant pressure that's pushing assets higher.
Right. And I think until you get a real deep recession, I don't see how house prices get hit the way that consensus is expecting them to. And obviously, commercial real estate's a completely different ball. Like, that's a different ball game. Um, there's more corporations that are, I should say, leveraged, right? More. It's more institutionalized than than the household, right? And 2008 was household converted into the households leveraged up and offloaded it into the institutions, which were basically defunct in the end, and the households were too. Whereas commercial real estate, again, different dynamic. There's not many, you don't have mailmen and basic level government employees. Not that there's anything wrong with those with basic level government employees, but you don't have them leverage to the tits buying four, five, six houses, right? Or three houses, something like that, right?
Right.
And it's not like commercial real estate is not, they're not directly affected. Where obviously, if something goes wrong in commercial real estate, shocks will flow, there'll be some effects, but they are not on the front line, which 2008 they were. So things, and I'm not talking about government employees specifically, I'm talking about the average folk, right? Um, the regular investor, the normie, right? They were on the line in 2008. Even with CRE, commercial CRE, they're not on the line at this point in time, the same way they were in 2008. So again, very different dynamic. I think we have to also take with a grain of salt how these commercial real estate deals evolve, and how they, you know, are some of these places converted into residential buildings, basically converting their value and increase and basically staving off that default. We don't know yet, and unfortunately, if you just go on FinTwit, you're going to see a bunch of bullshit as usual. Everyone likes to blow everything out of the water. It really seems like everyone's on this idea between the media, Twitter, and just common, normal. I want to say like
Like
the basic
consensus.
macro guy. Yeah, the basic macro guy and just regular people are thinking that commercial real estate bubble is going to destroy the economy,
Yeah.
which makes me think that that's the complete opposite, right?
Right. Usually that's the complete opposite from FinTwit consensus is what
Yeah,
happens. And
yeah, like
always remember, it's never going to be as bad as they say it will, and it's never going to be as good as they say it will. Whenever you see, oh, FOMO, we see it a lot in the crypto space, Bitcoin's going to 100,000, all this. Well, where is Bitcoin now? It's not nearly as good as it was. It's still fine though. You usually end up in the middle. And
right.
with real estate, it seems like that's exactly how it's going to play out. We're not going to get a major crash. We're not going to get real estate prices shoot up another 40%. We're going to be right in the middle. Housing will stay the same, maybe chug a little bit higher, and that's about it. It's going to be the least entertaining outcome. That's the most likely.
I think that's a great place to end off the podcast. Thank you so much, guys, for listening. If you have any questions, feel free to reach out to us at the Market Radar on Twitter or go to our website, market-radar.com.